is a money day, I believe so. But now we're going to talk about Tier 1 banks. We know that Proshare earlier had shared of their findings when it comes to Tier 1 banks, and they made some recommendations. Now they have the second edition of their report, looking at some details of Tier 1 banks, how it affects you and your banking, your money in your banks. And so joining us to give us more about the second edition, she's joining us virtually, even though she's here in Lagos, Ademidun Shogo. She's an economist with Proshare, joins us from Omole in Lagos. Ademidun, thank you so much for your time. Good morning.
Good morning. Thank you for having me.
Great. So I remember talking about the first edition of this Tier 1 banks, and I know that Proshare had recommended that the assessment should be done more often, because some banks have just been called Tier 1 banks. Even when they're falling off that ranking, they're still left in that ranking. So tell us, what are your findings in this second edition, and has there been any action taken on your findings from the first edition?
Okay, thank you very much for the question. So I just want to take us to the concept behind the Proshare Banking Index itself. So we wanted to capture banks, classify banks based on the recent evolutions. We can agree really that banks have changed, they've evolved from what we used to have before. So we wanted to have a broader, a fit for purpose. We have a classification of banks under the current or the evolutions they have currently, because we believe that the extant ranking actually is premised only on the asset size. And we've seen banks change, we've seen their risk change, their structure. We are from the universal banking, now we have the financial old school structure. So we wanted to capture all those things. We did that in our first edition. And after we did our first edition, we got some feedbacks from key industry players. We also assessed it ourselves, and we decided to expand the methodology. So in terms of the expansion of the methodology, we had an introduction of some new metrics. So we have, in terms of efficiency, we decided to include efficiency. It wasn't included in the first edition. We decided to include it this time around. Using it, we used the metrics, that is the cost to income ratio, to measure the performance in terms of how are banks optimizing the cost. We are aware of the inflationary environment, how cost is a major problem we have in terms of affecting the profitability of banks, and also even in the business space generally. So we tried to assess bank on that. We also introduced an integral part of banking now, that is the digital banking. We've seen banks expand from the traditional way to a new modern way. So we decided to look at the banking, the e-banking income, that is the non-interest part, in e-banking income relative to their gross earnings. So what was the percentage from digital income relative to their gross earnings? We included metrics under the risk management. So we included the cost of risk. Before we had the capital adequacy ratio, we included that. In terms of governance too, we have the independent non-executive director to the board. We looked at the percentage. So we added more in terms of the methodology. We included more metrics. So that actually led to we have some banks falling off, and we have the re-entry of some of the banks. So now what we're trying to do is that we've standardized it. We've looked at it. That means that a bank which is being classified under the Tier 1 and Tier 2 is an holistic overview of your performance. It's not only based on one particular metrics. It's every key component of banking that is being vetted, and to see that these banks are really Tier 1 and these banks are really Tier 2. So that was what we did in this period.
All right, interesting. But I'm just wondering, what's the essence? When you're done with this report and your observations, do you talk to the banks? Do you talk to CIBN? So what do you use the report for? Or is it just out there for knowledge sharing?
We actually engage with the industry players. We talk to the banks, so we get more feedbacks, reviews. So the report sort of gives them it's an assessment of their performance. So yearly assessment of their performance. So it gives them that, these are the points where we need to work on. These are the parts where we need to improve. So that's the things that we determine in the reports. We also give recommendations to, also based on the report, to the industry, even to the regulators as well when we do this report. So some of the recommendations we made is that we talked about the CRR, that's the discretionary. We have cash reserve. We noticed that the statutory cash, the CRR is quite high now and is actually hindering banks from lending. So we made some suggestions about reducing so that they can encourage credit to the real sector of the economy to boost the economy. So we make some recommendations even after the report, showing them their assessment, their performance based on the year. And also it can also serve as as a drive for investors. Investors can look at the report. They can make decision. It can inform their decision about what investing in any of the banks.
Yeah, I wonder if you engage the central bank, because when you talk of CRR and all of that, it's mostly from the regulator, the central bank.
So we just made recommendations. We engaged the industry. We made recommendations to the CBN, yes. But yes, we're just waiting for their feedback, yes. But we made recommendations under the report.
All right. So what next are we expecting from Proshare, a third edition? And then, of course, you have the issue of fintechs. They're also in the financial space now, challenging the banks and all of that. Do you consider them maybe in your next report or so?
So in this report, we talked about the importance of technology for banks. So we've seen the fintechs take that space so much and they've been able to optimize it. So they have, in terms of deploying services, products that are quite attractive to the consumer, to the consumers, to the customers. They've done it efficiently. We saw it for instance, during the cash crunch, there was the fintech that came to our rescue. We had most of our traditional banks, apps had issues. So that means that they have to prioritize technology. So we made suggestions that they have to deepen their technology. The deepening of their technology helps them to give customer-centric product to people. That means that most of your product or services is in line with the lifestyle of customers. And also it helps them in the past of cost. You've seen the CIR, that is the cost to income ratio of banks, rise because of the situation. And the fintechs have been able to minimize the cost that they use in carrying out most of their core activities. So technology is very important for the banks. The banks have to prioritize it in order to change, in order to stay relevant. So technology is a metric that is going to stay. As technology evolves, banks will have to strive to continue to integrate it so that they can stay relevant and continue to continue to be in the business and not to retain their position in the business. And also technology has helped in terms of financial inclusion. The fintechs have been able to attract the unbanked. We have in Nigeria, the percentage of people, the adults that are banked is around 47%. That suggests that we still have over 50% that are unbanked. The fintechs have been able to use numbers. We have so many products. We have their phone numbers to make people come into the banking system. So if we see banks follow through by making products that are very easy and accessible and convince people so that they can boost the confidence and the trust of customers coming into the banking system, that will be very essential for the economy and to help us drive the economy more.
All right. Thank you so much. Banks have some things to learn from fintechs. Thank you so much for sharing your findings at Proshare with us, Ademidun Shogo, Economist with Proshare.
Thank you for having me.